And for more on the People's Bank of China's reserve ratio cuts, we're now joined by Patrick Chovanec, Managing Director of Silvercrest Asset Management Group. Good to have you on the show. Thanks for joining us again.
Hello.
So People's Bank of China cutting its reserve ratio by 0.5% for banks that lend to the rural sector and to smaller companies. What's the impact of this?
Well, they've been trying to figure out a way to boost the things that they want to boost in the economy without boosting the things that they don't want to, overinvestment in particular. And they haven't really found a magic solution to that. I don't think this is going to be a magic solution to it either. I mean, if you lower the reserve requirement for rural banks, they make a loan, somebody establishes a deposit at ICBC, for instance, that means that ICBC can lend more. So my concern here is that this is really backtracking on the efforts to rein in credit creation in China, and it is going to fuel more investment, more overinvestment that's really been the problem in China.
So is that why you think the People's Bank of China stopped short of a broader reserve ratio cut?
Yeah, I think they've been resisting loosening monetary policy for some time, but they're under a lot of pressure because at the National People's Congress, they also set out the target of 7.5% GDP growth. And my concern at the time was that that was going to be a stumbling block to actually implementing a lot of the reforms that were envisioned, including the effort to rein in credit.
So targeting mid-sized or larger firms and giving them more credit, not the right idea, according to you?
Look, the problem is that China is addicted to credit-fueled investment growth, and you don't have to take my word for it. Premier Li Keqiang has said as much in numerous speeches. And he said credit-fueled stimulus is not really the way forward for the Chinese economy. It needs to be reformed.
But we are seeing a slowdown in both domestic demand and overall GDP. So what is the formula?
Well, the formula, I have to say, is to bite the bullet and to start explaining that the Chinese economy going forward is going to look very different from the Chinese economy of the past few years.
But how do you prevent a hard landing then? Perhaps we can accept a 7% instead of a 7.5, or perhaps even a 6.8, but we want to prevent a hard landing.
I'm not so sure that that's really the goal right now. I think the goal should be to put China on a sustainable growth path, and that involves creative destruction, and that involves a significant pullback from a lot of the investment levels that we've seen over the past few years. Now, that may produce GDP numbers that a lot of people don't like, but that's actually healthy for the Chinese economy to pursue that path.
Well, as you mentioned, the government does want to avoid an overstimulus. At the same time, the economy could use a boost, and they've done that through things like railway spending and encouraging infrastructure projects on a local government level. Is the solution perhaps a continuation of a stimulus through those means?
Well, you know, there are some investments that need to take place in China, but I think that, once again, they're trying to dodge the inevitable. They want a correction without actually having a correction in the economy, and that's true of the property sector as well. You know, they want prices to be affordable, but they don't want them to drop for any investors to lose their money. And this is the dilemma. You know, when you set out a target of 7.5% GDP growth or even 6% GDP growth, you need to shore it up. And the easiest way to shore it up is through the growth model that you've got. But you need to change away from that growth model to a very different kind of growth model.
Well, that has been the idea, to shift towards a domestic demand-driven economy. But the latest statistics out of May do show some concern there. We had exports up 7% in May, but imports fell 1.6%, and that is causing concern that domestic demand is not as strong as it should be and is perhaps not the fallback for the Chinese economy.
Well, it's what
or is it too soon to take those figures into?
I think what that shows is that there's been external rebalancing in terms of China's relationship with the global economy, but there hasn't been an internal adjustment of China's growth model. And so there's still, you know, it's hard to read some of these export numbers simply because there was a lot of distortions in the previous year, and these are year-on-year figures, so it's actually very hard to judge what they mean. But certainly a vibrant external demand buys China some space, but it doesn't change the equation that ultimately rebalancing towards a more consumption-driven economy is the way to go. And
that means accepting a what percent GDP?
You know what it means? It means actually raising interest rates. Because when you, conventionally in the West, we think lower interest interest rates, consumers will borrow and spend more.
Correct.
But in China, what happens is businesses borrow and invest more. And consumers actually have to save more in order to hit their savings targets. So artificially low interest rates in China is actually part of the problem. And actually raising interest rates to a more market-based level is part of the rebalancing that needs to take place. So I think they're going in the wrong direction here. But I understand the temptation that they're under a lot of pressure to try to shore up the growth figures.
All right. Thank you for your insights so much. Patrick Chovanec, Managing Director at Silvercrest Asset Management Group.